Trading for Beginners. This is Jeremy Fu. I'm an account executive with Phillip Futures, and in today's webinar, we'll be discussing a few basics on what is futures trading, as well as some of the fundamentals that drive the futures market. Before we begin, I'd like to do a sound check. If you can hear me loud and clear, just type yes into the question box. Also, during the webinar, if you have any questions, do type them into the question box, and I will address them during the Q&A session at the end of the webinar. Great. I think looks like everyone can hear me clearly. So let's begin tonight's webinar. So just to recap, the topic for today's webinar is back to basics, futures trading for beginners. My name is Jeremy Fu. Today's the 25th of August, and I will start on my webinar. So just a short disclaimer before we start on the webinar. So just to that all the information shared here is basically for educational purpose and should not be any recommendations for any of your trades. So the agenda for today, some of the topics that I'll be covering in today's webinar, some of the basics to futures trading, some of the key features of futures trading, the order types on our Phillip Nova platform, commission and charges, key fundamentals that drive the futures market, risk management, and lastly, how to begin trading with Phillip Futures, step-to-step guide. So what is futures trading? So a futures trading is actually a legal agreement to buy or sell a product at a predetermined price at a predetermined future date and price. So the buyer or seller must buy or sell the underlying asset at a predetermined price, regardless of the current market price at expiration. Many people misconceptualize that futures trading, you have to predict the price in the future. No, so this is actually a misunderstanding. So actually just a little bit on the background history, it was used in the past for companies to hedge against prices of their raw materials or products they sell, or used to protect themselves from adverse price movements. But since then, they have actually opened up the futures market to even retail investors for speculation. So companies would actually lock in a price so that they protect themselves from the price movements and therefore transferring their risks or rewards to the investors or speculators. So the futures contracts are traded on a centralized futures exchange such as SGX, CME, COMEX, or NYMEX exchange. So why should you trade futures? So futures is actually a leveraged product, so you'll be trading on margin. So the amount of money that you have to put up is much less than the contract size that you're actually trading. So just to note that, you see from the picture, you actually can see the investor, he just put a little bit, but you actually can trade a lot. So this is how the leverage actually works. Volatility, liquidity, depending on the contract that you're trading. Some contracts are very volatile and very liquid, and some might be less volatile and less liquid. Buy direction, so you can do long or short positions, unlike maybe, for example, stocks where you need to, there's a contra or the buyback period. So for futures contract, you actually can short if, let's say, you think the price is going to come down. Time flexibility, so depending on the market that you are trading, definitely you get a little bit of time flexibility. If let's say you are trading on the US market, you trade when the US market opens. It's definitely more volatile when the US market opens, so that will be around 8 p.m. our time. Let's say you're trading the Singapore market, then it will be, of course, about 8 to 5 our time. And then lastly, futures markets are regulated. So regulated market means that the market receives a certain level of oversight or control from either government bodies or industrial bodies. So this actually provides more transparency, as everyone from any part of the world will be receiving the same prices and the spread that you're actually trading on. This is actually not the same for OTC markets, where the prices and spreads can be altered by the broker or the market provider. So just to be assured that if let's say you are in Singapore, or if let's say you are overseas in Malaysia, China, or even in the US, if let's say you're trading the Dow Jones Futures, the spread and the prices is exactly the same at the exact same time. So should you buy or sell? So if you predict the futures contract price to rise, you should be going long or doing a buy. And if you're holding the long position and the price rises from the price that you entered, then you'll be in profit. If you predict the futures contract to fall, then you should be going short or you should be doing a sell. So if you're holding a short position or positions and the price falls from the price that you shorted at, then you'll be in profit. As spoken earlier, that you do not need to predict the price in the future. You would enter into a long or short position and the price difference would be settled at the expiration of the contract. However, even before the expiration of the contract, you can actually close off your contract or your position, and the price difference would be the profit and loss depending on the trade direction and the price that you entered. You can enter as many times as you like until the contract expires. So you can just do your trading as per normal. It doesn't have to be enter and then wait until the contract expires. That is a slight misunderstanding that some people have on futures contracts. So some of the categories of futures market, as compared to an equity or a stock which represents the value of a single company, a futures contract actually represents an entire market. So the futures contracts can actually be categorized into four main market categories: financial, metals, energy, and agriculture. These, if you're trading any futures contract, it should be categorized in these four main market categories. So the financial would be mainly your index, Dow Jones, S&P 500, Nasdaq, or even some of your currency futures. Then secondly will be metals. So you got gold, silver, platinum futures. Third would be energy. So crude oil, Brent oil, natural gas futures. And then lastly, agriculture. So sugar, soybean, wheat, rice, cattle. These all fall under agricultural. So some of the basics of futures trading. So actually, I just got this snapshot from our Phillip Nova trading platform. So some of the things that you might want to note. So at the top, if you see CME, E-mini, S&P, September 20, this would be the exchange that you're traded on, the contract name as well as the date, as well as the contract date. So the CME would be the exchange that you're trading on. The contract in this case would be the E-mini S&P, and then September 2020 would be the contract date for the futures contract. So in this instant, it will be September 2020. Then you can see the low and high, the 3347, 3379. This is actually the low and high price for the session. And then on the right hand side, it will be volume. So the volume will be the total volume traded for the session. You see the last 3367.25, that's the last traded price. Then to the right, 3352.75 will be YDSP, which actually stands for yesterday's daily settlement price. And then to the right, change, if you see 14.5, this is actually the percentage difference between last traded price and closing price. And then lastly would be the bid and ask price. So basically, if you're buying or selling at market, this would be the buy and sell price. So some of the key features of futures trading. So some of the contract specifications that you might want to know when you're trading the futures contract. So for my whole webinar today, I'll actually be covering a little bit more in depth in mainly these four contracts. The micro E-mini Dow Jones Index Futures contract, E-mini S&P 500 Index Futures contract, the WTI mini crude oil futures contract, and the micro COMEX Gold futures contract. So some of the specifications that you might want to take note when you're trading a futures contract are these few. So they are listed below. The contract size that you're trading, the trading hours per session that the contract is being traded, price fluctuation, dollar value of one index point if let's say the futures contract you're trading move by $1 or $5, how much are you actually earning? because it's not relative as it's a leveraged product. The commission per contract that you'll be paying, the contract months that are listed, and the delivery, is it a cash or physical delivered product, and the expiration date. So I've just listed out roughly. I will just go through quickly, roughly what it is. So the Dow Jones Index Futures contract, as well as the S&P 500 Index Futures contract, are mainly cash settled products, futures contracts, while the commodities such as the crude oil and the gold are physical delivery products. So just go for example, the Dow Jones Index, the contract size would be a 0.5 times the index. Trading hours for all four would be Singapore time 6 a.m. to 5 a.m. But obviously it gets more volatile when the US market opens at about 8 p.m. our time, when the US markets all open. So let's say, for example, the Dow Jones, the price fluctuation is per $1. So every dollar movement in the Dow Jones would be a 50 cent profit or loss on your end as an investor. And then the commission, now we're actually having a promo, would be $1.50 per contract. And for the US index futures contract, is actually a quarterly contract. So the contract months will be March, June, September, December. So cash settled, and the expiration date would be the third Friday of the contract month. So if let's say you're trading the September contract on the third Friday of September, the contract will expire. You can close off anytime before. If let's say you expire, then as I said, the difference in the price would be your profit and loss, and it'll be adjusted accordingly. So move over to the commodities. So for the mini crude oil, this is actually the smallest size on the NYMEX exchange, and it's for 500 barrels of crude oil. So the price movement is 0.01, a little bit different from the index futures. So per 0.01 price movement, it will be a US dollar $5 profit or loss on your side, depending if let's say you went long or you went short. And the commission is slightly more, US dollar $8 per lot size, and it's actually a monthly contract. So you have January, February, March, April, all the way until December. For commodities, there is a first notice day and last trading day. So the first notice day actually refers to the date that the deliverables for the commodity start. So for long, this is for long futures positions for the first notice day. So for retail investors, you will need to liquidate your positions before this date, or we will actually force liquidate for you to prevent any physical deliverables. This works similarly for the last trading day, which is applicable for the short positions, which you will need to close before the last trading day. So these are for short positions. I'll just go quickly through the gold. So the micro COMEX gold is actually a leverage gold product. So the size will actually be 10 tri-ounce of gold, and the price fluctuation is 0.1. So any 0.1 price movement would be a $1 US dollar profit or loss on your end. And this is actually under our current commission promotion. So it's actually US dollar $1.50 per lot. And the contract months would be the even months. We're skipping October, the more liquid months. So February, April, June, August, and then December. So some of the order types that we have on Phillip Nova. So obviously market order to buy and sell at current market price. And then you have your limit orders. So the buy limit would be, if you see from the photo, you can see that if let's say the market price is the red dot, and you're waiting for the price to come down, so you're buying at a price lower. So if let's say the market price is currently $1, you'll be actually be queuing maybe to buy at 50 cents or 60 cents. And once it hits that price, it would do a buy order for you. Similarly for the sell, it's a reverse. So if let's say the current market price is $1, you'll be queuing for something, anything above $1, maybe $1.20, $1.50. And if it hits that certain price that you input, then they will initiate a sell position for you. So it will open a position for you. The buy stop, sell stop, So it's actually different. So if you look from the buy stop, if the red dot is the current market price, you are actually queuing for a price above to do a buy. So just a little bit different from the limit orders. And then you have the buy stop limit and then the sell stop limit. So this one is once the stop price is reached, the stop order becomes a limit order to buy or sell at the limit price or better. So actually you are just providing a range in which you want to be filled, and if let's say you are not being able to fill within this range, then the order would be cancelled or expired. So futures order types, so obviously there's market order, and then you have day orders and GTC orders. So day orders expire at the end of the session. So if let's say the session is 6 a.m. to 5 a.m., if your day orders were not triggered at 5 a.m., they'll expire. So if let's say you have a stop loss, just make sure that it's a GTC order, because if let's say a day order and the market moves against you, then don't want you to run into heavy losses. So the GTC order are good to cancel, so they won't expire until you cancel them. But just remember that you have the GTC orders, so that it doesn't create any open positions or you forget about the order, because it will actually remain there in the system. So no holding of long and short positions simultaneously for same contract months. So for example, if let's say you're trading the Dow Jones September contract, you are not allowed to hold long and short positions. If you have a long positions, they'll be squared off on any short orders triggered or short orders to which you executed. So yep, in my next point, yep, that highlights that long positions for same contract, same month will be squared off on any short orders triggered. And then similarly for short positions, it will be squared off on any long orders triggered. With that said, you actually can hold simultaneous long and short positions for different contracts or same contract with different months. So for example, you can definitely hold a long Dow Jones position and you can actually short the gold, for example. That's totally fine. And similarly, if let's say you're trading the Dow Jones September long position, you actually can hold a short position on the December contract. So yeah, just to note that there is for the same contract month, um, you will not be able to hold long and short positions, but for different contract months, you'll be okay. So commission and charges that you're paying. So as the futures contracts are exchange traded, the commission chart is incorporated with exchange charges and clearing fees and any other costs incurred. So with that said, there is a necessary cost price involved paid to the exchange, so it can't be running on a 0% commission structure. So if, for example, if let's say the commission stated is $3, when you open a trade, let's say for one lot, $3 will be charged, and then another $3 charge when you close the trade. So total will be $6. So it's not only the $3, it's $3 when you open and then close. So the total round trip will be $6. So for the futures contract, no overnight swaps or charges or financing costs involved. This is actually the key difference between futures products and CFD or Forex products. So for Forex and CFD, there is the swaps or the financing costs when you hold your position overnight. So for futures contract, there shouldn't be any overnight swaps or charges when you hold your positions overnight or over the day. So the cash settled products will expire and the settlement price will be given to offset your positions, and the necessary profit and loss will be adjusted accordingly. And then physical delivery products will be auto liquidated by Phillip Futures to avoid any undertaking of deliverables. But yeah, just to reiterate that before the expiry, you can actually close off your position, and the difference between the price you entered and the price you closed would be your profit or loss accordingly. So you can do that as many times as you want until the contract expires. So roughly what drives the futures market? So a little bit on what is fundamental analysis. So So what is fundamental analysis? So it's actually the evaluation of financial, economic, and geopolitical factors surrounding a particular financial product to determine where the price might be headed. This incorporates micro and macro economic variables, industry conditions, and other tangible considerations which can influence the price. So if you did know what is macroeconomic factors, it's actually looking at a big picture. So for example, if let's say you are trading Dow Jones index, whether it's the futures, whether it's CFD, let's say the Fed today says that they want to increase interest rates. So for example, the Fed raises interest rates. This typically leads to less borrowing by growing businesses and ultimately a slower rate of economic expansion. Therefore, investors of equity index futures, such as the Dow Jones Index, would likely interpret a rate hike as a bearish signal. This would lead to the Dow Jones Index actually falling in price because an increase in loan and let's say mortgage rates for your mortgage loan equals to less disposable consumer income. Consumers less spending income equals to lower business revenue. Dow Jones is a composite of a 30 different companies, which I'll be covering more in my slides. So, yep, if the businesses have less revenue, they report less, therefore stock price falls, therefore Dow Jones index falls in price. Then you have microeconomic factors. So the main microeconomic factors would be demand and supply. If you study economics, I think you know this. So for example, recently due to a reduce in oil demand because of the recent COVID-19, oil prices started to drop rapidly. So in order to curb the drop in demand, the OPEC, which is the Organization of the Petroleum Exporting Countries, that's what it stands for, the leaders and the members decided on cutting oil production amongst its members. So a drop in supply would therefore lead to an increase in price due to a demand and supply. So it works both ways. So an increase in price, increase in supply would lead to a decrease in price with the demand and supply model. So major companies driving the Dow. So just a little bit on the, I just go in depth into the four contracts, futures contract that I mentioned earlier on. So the Dow Jones is actually an index measuring the stock performance of 30 large companies listed on stock exchanges in the United States. So if you heard, it's actually one of the leading index for the US market, US stock market. And although there are 30 listed companies, the weightage of each company is actually different. So these are actually the five most heavy weighted companies on the Dow Jones Index as provided by Bloomberg. So Boeing Company, United Health Group, Home Depot, McDonald's, and Apple. So any stock price movements in any of these five companies would definitely affect the index much more than the other 25 companies. So you definitely have to look out for these five companies when you're trading the Dow Jones and their stock price as well. So a little bit on the S&P. So the S&P 500 is actually a US index measuring the stock performance of 500 large companies listed on the stock exchange in the United States. So although there are 500 listed companies, the weightage of each company is actually different. So I just listed the top 5 weighted companies on the S&P index as provided by Bloomberg. So the 5 would be Microsoft, Amazon, Apple, Facebook, and then Google. So definitely, as per the Dow Jones Index, any stock price movements in these 5 companies would lead to a significant movement in the S&P 500 index. So why should you trade an index instead of a single stock? So I always feel that it's safer to trade a basket of companies, as a single bad news can send a company's stock free fall falling in a day. So when you trade a basket of companies, the movement of the company's stock in the index is cushioned by the performance of the other companies in the basket index. So you don't have the index falling all the way. If let's say one company crashes, it wouldn't be free falling all the way down to zero. So the US index provides indication of US equities markets, and they usually move in tandem. So if genuinely the US index moves up, generally majority of the US stocks are moving up, as in theory. So some of the economic data to look out for when you are trading the index would be interest rate decisions. So by the US Central Bank, that's the Federal Reserve. Non-farm payrolls, which is a job report on a monthly basis, every first Friday of every month. Inflation rates, and then gross domestic product, or GDP. So these economic data would definitely affect the index and US equities or stocks quite heavily. So what you want to do is look at economic data that compares previous forecasted and actual data. But this is actually not to be used to predict any market movements, but you can trade on probability based on the data provided by the analysts to predict future market movements. So, for example, if let's say the Fed is going to increase interest rates, and it's largely expected that they're going to increase interest rates, therefore the index might fall in price. So you can use that to your advantage to do your necessary trading and to trade on higher probability. So gold prices. So some of the major factors that are driving gold prices. So if you didn't know, gold prices has been constantly rising. It touched an all-time high of 2070 as of early August. It slightly dropped now to about 1940. So yeah, there was a slight sell-off there. As you know, whatever goes up must come down. So at a certain point, it had to come down. It can't be a straight line going all the way up. So a little bit on a backdrop on roughly what is gold and what's actually driving gold prices. So actually, gold prices is mainly driven by demand and supply. So central banks and investors have actually diversified their assets into gold as it hedges against paper currency devaluation. So and inflation, deflation, and acts as a safe haven in times of global uncertainty. So maybe in the last few years, central banks and investors realized that if there is a crisis and there is currency devaluation, the gold price generally doesn't drop so much in value, and therefore, the value of gold over time would definitely just only go up as it's a safe haven and anything. And you actually can see that from when the COVID-19 started, gold price has accelerated so much since then. So in global uncertainty, it goes up so much, but because it's viewed as a safe haven. So some of the major factors: demand and supply. If there's more demand and not enough supply, therefore the price just rises all the way up. Geopolitics. So if there's any crisis or uncertainty, gold will definitely go up because people view currency might devaluate over time, but gold only will go up over time. So the gold also has a inverse relation with the US dollar. Generally, if the US stock market is not doing well, people tend to rush to buy into safe haven assets such as the gold, and also based on the US economy. So yeah, just said earlier. So the last one, WTI crude oil. I don't know if you maybe have heard people talking WTI oil, WTI oil. So the WTI actually stands for the West Texas Intermediate, and is a crude oil product and an oil commodity that is mainly sourced from US oil fields and serves as a benchmark for US oil prices. So with that said, if let's say you heard what Brent crude oil actually serves as more of the international benchmark for the oil prices, and while the WTI is more a benchmark for US oil prices, as is mainly obtained from US. So the both Brent and WTI crude oil are light and sweet, so this actually makes them ideal for refining into gasoline. So it's actually quite popular as gasoline, petroleum is widely used across the world. So it was infamous as the oil that went into negative prices in April 2020. So since then, the WTI has staged a recovery since then and now resides just over $40 per barrel. So some of the major factors driving the WTI crude oil prices. So definitely demand and supply. If let's say oil demand comes down and there's still the same amount of supply, therefore the oil price would come down. So that's why we saw the oil prices actually go into negative. The oil demand just completely dropped, and people were actually paying people to take the oil off their hands. Therefore, it went into a negative price, and that's what the negative price actually means. Geopolitics. So definitely, if there is a pandemic such as the COVID-19, for example, definitely oil price goes down, therefore price comes down. There's actually also for economic data, there's actually a weekly oil inventory report for the WTI that comes in on a weekly basis. So if there is a small, less stockpile buildup in the oil inventories when they report, then generally the price tends to go up. And if there is a large stockpile, which means that the oil wasn't used and it's piling up in the factories or warehouses, then the price would therefore come down. So of course, the OPEC, which is I said earlier, the organization of the petroleum exporting countries, if they say anything about the cutting about oil supply, or they report on the oil demand, or they come up with any oil reports, it would definitely affect the WTI prices as well as the Brent crude prices. So if let's say you didn't know what the OPEC is, actually consists of 13 countries producing oil, and there are a few leaders leading the organization, and it's actually a organization set up to coordinate and unify the petroleum policies to ensure a stabilization of global oil prices around the world and markets. So the WTI also has a inverse relationship with the US dollar because it's a oil produced product in the US. Therefore, yeah, the inverse relation. So risk management. So futures trading is a leverage product. So with less, you actually can trade more. So just to note that leverage is a double-edged sword. So your profits can be magnified, but your losses are also magnified. So it is very important to practice good risk management so that not to bust your trading account or run into huge losses. So have some knowledge every time you place a trade, whether it's a fundamental or technical knowledge, so that you reduce your market risk accordingly. So the number one rule to risk management is always have a stop loss. Always have a stop loss in place. When you are trading leverage product, losses are part and parcel of trading. So you need to take losses. You cannot be right all the time. If you be right all the time, then you'll probably be a millionaire by now. But yeah, so it's always better to take a small loss now than a big loss in the future. Without a stop loss, you could easily wipe out most of your account. Maybe if let's say you were trading stocks, maybe if you bought let's say 10,000 shares in SIA, Singapore Airlines, and the price of the stock drops all the way to $0, the amount that you have lost would be the total amount that you invested in. But with leverage products, if the market moves against you, it's a magnified loss. So you could the product doesn't need to go all the way to zero for you to wipe out like your whole trading account already. So just to make sure that you know this and to practice good risk management. So of course, do not move your stop loss to prevent any realized losses, or even remove your stop loss. Have it in place all the time in case the market moves against you for maybe apparent reason. So if you think about it, you could have been stopped out, you flipped your position and be profitable. This is one key thing that many people don't do, is to just flip if the market sentiment is moving away, or maybe there was something that hit, maybe like COVID-19. You don't want to be long on the Dow Jones. Another pandemic hits, you want to flip, you want to go short, and then you could be profitable from there. So do not focus only on your entry and take profit. You need a stop loss in place. Majority of why investors lose money is because they take profit too early and they cut losses too late. So practice good trading discipline, have a stop loss, have a good risk management, and I'm sure if you know how to read the market with my help, hopefully we can be profitable in the long run. So minimizing losses and maximizing profits. So if you do not have time to monitor the market, place a working order, a GTC or day order to, put your entry points. You can always put a GTC. If let's say you don't want to monitor the market and you want to enter at a certain price, you can put a working order to enter at a certain price that you want. And when in profit, you can move your stop loss to your break-even point so that if the market suddenly moves against you, you would be covered. If you want to know a little bit more on this, I actually have a video on YouTube on our channel. You actually can text me for the link, or I can provide you the video afterwards. So yep, if in profit on trending markets, increase your take profit target or reward ratio to maximize your profits as much as possible. And if you get stopped out, reanalyze, was there a change in the trend or market sentiment, and then look for better prices to enter. So just remember, losses can be profits. You just picked the wrong way. It's a 50-50. If you didn't get it this time, you probably will get it next time. The number one problem that people are not profitable is because they do not know how to cut their losses, and therefore you don't have a good risk to reward ratio. Yeah. So that's me, Jeremy Fu. My handphone number is there. My email is there. If let's say I can't answer any of your questions today, I don't get around all your questions, do feel free to drop me a text or a call at my handphone, or drop me an email with your questions, and I'll reply you from there. So some of the things that I actually provide for my clients, if let's say you are interested to open an account under me, I do provide daily news updates, which I send by WhatsApp on a daily basis. So every day I'll send you. I also send you a weekly economic data update, which I will show you in my next few slides, roughly what all these will look like. Daily technical views and advice on trades. And as well, if let's say you are new and you want to get started, you want to learn a little bit more, of course, I do a one-to-one coaching. Either you can do face-to-face right now, they have eased the lockdown a little bit, or we can definitely do a one-to-one on Zoom, which I think is relatively practical. If let's say I would prefer that then if you keep registering for many webinars, that might not answer your queries, or it might not be specific to what you want to learn. I think the one-to-one would definitely help. Much more interactive, and I can definitely cover much more grounds and answer all the questions that you might have. It's completely free, no need to pay anything. Yeah, so let me know if you'll be interested. And I'm always contactable, so you can drop me a text during office hours, and after office hours, I will usually reply you as well. So just to cover roughly what it will look like, so this is the economic data table. Don't need to go too in depth, but just to take note, just some of you definitely can find these online, but actually I highlight the important parts that you will need to take note of. So some of the things, maybe let's say for the OPEC meeting. So if you look on the part that says Thursday, March 5th, so if they have an OPEC meeting, it's definitely going to affect. They'll definitely discuss issues regarding the oil supply, oil demand, and they will implement policies to curb that, whether it's an increase in demand or decrease in demand, and then alter the supply. So definitely, if they meet, they're going to discuss things like this, and then it's definitely going to affect oil prices. Lastly, we have the non-farm payroll. So this will be the job data, which is really important. One of the second most important reports that come out besides interest rates every month. So the job report basically shows how many people are unemployed and the earnings for the US citizens. So this would definitely affect the US. Let's say you're trading the US index, Dow Jones, S&P is definitely going to affect, and it's going to in fact affect things like, if let's say the job market is not good, it's definitely going to drive other things like gold prices. So these are a few things that I sum up and I'll send to you on a weekly basis. So hopefully with this you can be updated on the news for the week. So some of the trade advice news tips that I send on a daily basis. So if you see on the left hand side, it's a trade advice. This one is for the currency. So I would occasionally I would provide some trade recommendations for you, whether to short or long, as well as give some entry and exit points as well. Then the second one, we have the economic data table that I would be sending to you on a weekly basis. I also highlight if, let's say, there are any holidays for the day. If, let's say, the US market is closed today, I'll also be highlighting that. And then the last two would be the daily news updates. So you can just take a quick glance. You can just take a quick glance, maybe focusing on, let's say, the US index. US index fell last night as reported. Cases spiked. Dow Jones closed 700 points lower. Also highlighting the important US data that is coming up for the day. A little bit on the gold and crude oil as well. So it's specific to what most of my clients are trading and the most popular ones. But if, let's say, you are trading a certain product and you want to get a little bit more on that, like, feel free to contact me and I'll try to give you my best support and advice with regards to the certain product that you are trading. So hopefully with all this you would be equipped with the right tools to do good trading, and hopefully can be profitable in the long run. So yeah. So if, let's say, you feel that the information that I provide is not enough, which is always good to source your own information. There are a lot of free websites online that actually do provide information that you can source for trade advice or analyst views and news that can be very helpful for you. So for example, we do send out our daily market commentary. You can see Forex Factory, CNBC, Bloomberg, investing.com, FX Street, Daily FX. All these are not only they don't only provide for forex trading. They also have a lot on providing good levels for index trading, commodities trading. So you can definitely look here to take a look for more of your trading needs or views that you want to look at. The more views you look at, if 5 analysts say price is going to go up, probably the price is going to go up. If you get, the more probability you get, then the better prediction you can get on the market. So that's the idea. Yeah. So how to get started, a step-to-step guide. So I would get started on the demo platform. Unfortunately, the Nova platform doesn't allow for placing of any trades as there are no funds. So it will mainly based on a platform polymerization. So you can do that for about 1 to 2 weeks. And then after that, I would actually advise you to open a trading account with us. It's free. You can do an online account opening as well, and then you can maybe start on a small futures contract. Maybe you can do the Dow Jones, because as I said, per point movement would be 50 cents for the micro. So if, let's say, the Dow Jones moves 200 points against you, your losses will only be $100, which is really quite maintainable and reasonable. And hopefully you can just guess the right way and you can be profitable in the long run. And after that, once you understand and you get used to the platform, you need to incorporate these some simple fundamental and technical analysis in your trades, and then after that, hopefully to utilize the fundamental and technical in your trades. So if you think that trading leverage products such as futures or forex is a get rich scheme, you can turn your $500 to $5,000. No, not so easy, but I wouldn't say it's impossible, but you have to be quite lucky. So what I want is actually to create a trading journey for you and to assist you along the way, all the way. So trade with money you have, not money you need, and this is not a get rich scheme. And if let's say you start trading futures and you realize it's not the market for you, we can explore into other financial products to suit your trading style or your risk appetite. So some of the things to consider. So obviously know and understand the product that you're trading. And then secondly would be choosing the right broker. So you want a broker that is regulated so that your funds are saved, and if the company collapses, you will still have your funds. You will still get back the money you have in your trading account. You don't want a broker that charges you whenever you deposit or withdraw your funds. So we don't have any charges when you deposit and withdraw funds. You want a broker that's contactable, or that you can contact at all times, and of course a reliable and stable platform. So our Phillip Nova platform is a stable platform. So it should definitely be enough for you to do your trading. And lastly, of course, understand the risk of the product that you're trading, and hopefully I can help to develop a trading strategy that is suitable for you. So some of the account opening requirements: the minimum deposit will be 500 Sing dollars. Of course, not much futures contracts that you can trade with 500 Sing dollars. So obviously, I would encourage you to deposit a little bit more depending on the contract that you're trading. Like the lowest margin ranges between 1,000 to about there. So somewhere there would be a more significant and realistic amount to start your trading. So we do have the online account opening. So if you do just submit a plain application, every account that we have would be tagged to a specific broker. So if you do not indicate my name, it will just be auto assigned out to another broker. So if you liked what you see, do contact me. Either let me know when you've submitted your application, or indicate my name on your application on the third page of the account application under the please, how do you know about Phillip Futures? Otherwise, I will scan a QR code at the end of the webinar. You can scan the QR code from there to open the account, and then it'll be automatically tagged under me. You can use your phone. You can do the full account opening on your phone. Just to make sure you have your soft copy of your bank statement to submit with the account opening. And if let's say you're using the SingPass, then of course your SingPass details is needed as well. So besides all that I'll be providing you guys, if let's say you decide to open an account under me, we do have a trading central, which is actually a technical view. So if you can just see over there, they do send some technical views and trade recommendations for, let's say, the Dow Jones, for example. So you can see this was dated August 13, 2020. They actually provide you with some levels. So they predict that the price is going to go up today. They base their recommendations on the moving average 20, moving average 50, and the Bollinger Bands, and then give you some take profit and stop loss levels as well. Secondly, the daily commentary update. So we will send every day at least one time to you by email. So this will be giving some news updates on the news. So a few promotions that we are running. So actually we are running on the US micro index, which covers the 4 index: S&P, NASDAQ, Russell 2000, as well as the Dow Jones and the micro gold. So this is actually the lowest in the Singapore market. So if let's say you're interested, do start trading now. It's a good promotion that should run until the end of the year at least. So don't miss out on the good promo. It used to be 8, so now it's 150. So it's a lot of promotion there. If you are trading, if you're interested in trading the Singapore Straits Time Index or the SIMSKI, it used to be $10 SGD. Now it's $3.99. So grab the good promotion now while you can. We still have the refer a friend. So when you refer a friend and your friend trades at least one lot within 1 month, you actually receive a $88 referral fee for your friend that you recommended. So this is still applicable. So yeah, if you have a friend that if you have an account and you want to recommend your friend, do so and then get the reward. Yep. So besides futures trading, we do have Forex and CFD trading. This will be running on our MT5 platform, which is running on a 0% commission. If you're interested, do contact me. Drop me a text, drop me an email, drop me a call, and I can actually discuss with you more regarding this product and the products that we offer. So zero commission, very lucrative to doing a lot of intraday or swing trading during the day. So yeah. So yep, I've mainly come to the end of my presentation. So yep, I'll just leave it here. If the QR code here is to, if you want to open a trading account with us and you liked what you saw today and you want me to be a broker to help assist you, to teach you new things, I will definitely be here for you to whenever you want to learn. Maybe you want to learn, about the Dow Jones, or maybe you want to learn a little bit on the moving average. You can like if you are under me, I'll definitely be providing you that one-to-one service. We can do our coaching or sessions on Zoom or face-to-face, up to you. But you have to open an account with us. Otherwise, if you got any questions, do drop me a call or email. Yeah, feel free to do that. I'll just take some questions now from the audience. Let me just see. Okay, so one of the questions that I got was, what is the margin required for micro gold futures and the E-mini, NYMEX E-mini crude futures? Okay, so just let me get you the exact amount. So for the micro gold, the margin required would be Sing dollars, $1,200, so 1.2K. So with that amount, you actually can open a position in micro gold futures. For the NYMEX E-mini crude oil would be 5.6K. So you need at least 5,600 Sing dollars in your account to open one contract for E-mini crude oil futures. And I think there's a follow-up question that says, what is the difference between Nova and MT5? So the Nova platform would be our futures trading platform. So mainly it's only futures trading. And then MT5 would be a Forex and CFD specific trading platform. So depending on the product that you would have, that the product you want to trade, you have to go to the different platforms accordingly. So if you want to trade futures, it has to be on a Nova platform. If you want to trade Forex or CFD, it has to be on an MT5 platform. They are two separate accounts. If let's say you open both accounts, you want to trade both, you'll be given two separate accounts, and you need to fund both accounts separately. The funds are not shared. Yeah. Another question, what is a margin call? Okay, so what is a margin call? So for example, if let's say you have maybe, okay, so the like I said, the necessary margin to open let's say micro COMEX Gold futures is 1.2K. So if you put maybe let's say for example 1.3K, and suddenly the market moves against you and you incur more than $100 loss, therefore your equity drops below the margin required. Therefore that is what a margin call is. So you will need to top up in order to hold your positions, and you will need to top up within 2 days, or we will actually liquidate your position to avoid any heavy losses. So that is the margin call. What is margin call? Of course, if let's say you had $10,000 in your account and the margin required is maybe $1,000, only when you incur 9,001 losses, then we'll issue you a margin call. So yeah, I hope that answers your question on what margin call is. Okay, so another question was where to find market view about the Nikkei 225. So I think there are a lot of online sources regarding the Nikkei 225. If let's say you are interested to trade the Nikkei, I actually can help you source out information or market views, websites that actually have good views on the Nikkei. So yeah, if you're interested, and you start trading on the Nikkei, definitely, I'll try my best to look out for websites for you that you might be able to view regarding the Nikkei. Yeah. Yep. So the last slide would be if you want to try out the Philip Nova and view some upcoming webinars. I'll actually just do a short demo since we just have a few more minutes just to roughly see what the Philip Nova platform looks like. Okay, so basically, this is what the Philip Nova platform will look like. This is obviously a demo account, so if let's say you had some funds, you're able to see your fund account balance at the bottom. So just to go through roughly, you would add your contracts here. For this example, I showed the Singapore Simski or STI. And then once you click on the place order, the order tab would come up, and you can see roughly the what I showed you just now, the high, low, the volume traded for today. You can see the bid and ask price, and then you can increase or decrease your quantity from here. And then this would be your order type. So of course the market would be buy and sell at current market price. Um, and then you have your limit. So when it says limit stop without the GTC means that they're day orders. And then Yep, so then the GTC will be good to cancel orders. So once you place it, obviously, I can't do this now because it's a demo account, so they won't allow for any trades. So, but if let's say you did it, then this will be, yeah, for example, and then yeah, and then you can change the price accordingly. Maybe you want to put a GTC stop at maybe 295. This will roughly what it looks like. Yeah, so um it's not too fancy, but yeah, it's definitely good enough for your trading. You can draw up the charts as well as the market depth. Maybe you can just take a look at the chart. So yep, here you can take a look at the chart. You can enhance it to make it big, or you can make it small. And then you can change the time frame: 1 minute, 5 minutes, 15 minutes, 1 hour, 4 hours, 1 day. And then you can add the necessary indicators if you like, and then you can zoom in, you can move left, move right. So yeah, the charts are pretty decent. You can change candlestick to the bar charts accordingly, whatever you like. Add your indicators as you want. Yeah, so this would be basically the Nova platform. It's a web-based, so you have to open it from your browser. It's not an application where you can download from the App Store or Play Store. So just to note that, yeah, that it's a web-based platform. So you have to go to your browser and you have to open it up, and then you can place your orders. And once you place your orders, you're able to see it below here, and then your completed orders once it's filled. Any of your open positions you can see from here. So yeah, it's a yeah, you can yeah, definitely enough for you to do your trading. So yep, I think that's about cover it. Maybe I just take one more question. What time frame would you use for futures trading? Um, so okay, I mean, I don't really understand your question, but maybe I'll just try. So depending on the time frame that you like to trade, if let's say you're holding your contracts for a few days, then definitely you want to look at more of the daily chart. But if you're more of a position or swing trader, then maybe you want to look at the 1 hour or 4 hour time frames. And definitely, if let's say you're plotting indicators, generally for me, and I think for most people, it's always good to plot your indicators on the 1 hour chart and above. Then you can definitely see more of the indications or the chart patterns or trend channels. Because if you plot your indicators on anything below 1 hour, they'll actually be the indicators will actually be more capturing on the market fluctuations rather than the trend movements or proper indications. So yeah, definitely if you plotting your indicators 1 hour chart and above, and if maybe you're a swing trader or position trader, I would advise to put your to position to look at the lower time frames for good entry and exit. And then definitely if you hold your trades for a few hours, then the 1 hour 4 hour is more applicable for you. But if you're holding your trades long term, then definitely you want to look at like 4 hour or 1 hour charts to look at the trend pattern. So yeah, I hope that answers your question. Yeah. So yeah, I think it's run slightly over 8 o'clock. Thank you all for being such a great audience. So that's all the time we have for today. Thank you for being such a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available in our follow-up email tomorrow. So if you have any queries on the webinar or would like to get started, simply reply to our email and we'll get in touch with you. So with that said, yeah, do feel free if I didn't answer any of your questions, to drop me a text, drop me an email, and I will reply you from there, and hopefully we can get started from there on your trading journey. This is Jeremy Fu signing off. Have a good evening ahead, and thanks for attending my webinar today. Bye bye.